stocks run up. So we'll see what the big cue is today. But meanwhile, if you're looking for global cues for direction, they're definitely positive. And you spoke about Apple. Apple was the exciting breakout. But not just that. I mean, if you look at the three key indices, you would say a bit of a mixed run because the Dow ended mildly in the red, but the S&P 500 and the Nasdaq have now closed at record highs. They've had a winning streak for the last 4 consecutive trading days. So that has been good. Dow futures also completely flat at this point. So what really is sticking in the US markets? Remember, we had the Fed outlook yesterday. You had CPI. Today, you've had PPI data coming in, Producers Price Index, and that wholesale data is actually down 0.2% month on month versus an expectation of a 0.1% increase. So that's another positive surprise after the retail inflation data that has come in. Enough for bond yields to really behave themselves, I would say. The 10-year now firmly below the 4.3% mark at 4.28%. So from an India perspective, bond yields benign, they're looking good. Crude as well. So crude had a bit of a spike up, but then has retraced nicely. Brent, in fact, below the $82 level. And you're seeing NYMEX as well, over 0.5% down right now. Asia is a bit mixed. Bank of Japan decision on interest rates is expected. So you're seeing the Nikkei a little bearish, and you're seeing most of Asia in the red, though not really massively negatively. Similarly, let's pull up the implied open. Even from an India perspective, you're not going to see a huge swing, perhaps one way or the other. So sideways trade, and that trend continues. It was widely expected after the whole election event was done, and that is being seen. Very sector-specific or news-specific impact in the markets last couple of days and most of this week. In fact, let me pull up fund flows. Fund flows also haven't been massive. I mean, better than what we saw yesterday, but I mean, you had DII selling 500 odd crores, FIIs also selling about 3,000 odd crores. So I reckon, Niraj, a huge rejig happening for FIIs on a lot of factors which are not just about India. We've been looking at it in a slightly insular fashion, perhaps, saying that, okay, election's done, FIIs money will pour in, but they have bigger fish to fry.
Yeah, and also, I mean, so yesterday's number also, by virtue of the fact that SAF Partners sold out that large deal as well.
Deals,
so a lot of block deals as well that happened. But your point is absolutely
L&T
well
Finance,
noted.
Bain Capital, so a lot of stuff happening.
Yeah, a lot of that action also. But frankly, I mean, if you just think of it broadly, the long and short of it, if you think of it, the action is largely in bottom-up ideas while the index stays flattish to maybe marginally higher. I mean, think about it. We are at 23,400, circa the levels which we were at the day of the exit poll on that Monday. So no big dramatic changes there. And for the last 4 or 5 days now, the point of resistance seems to be at 23,500, right? Because that's where the call writers are firmly holding out and remains like. This is the third or the fourth day that I'm talking about how the call action is so high at 23,500, and it stays as the biggest hurdle that the index needs to eclipse if it wants to move higher. Let's see if it does. And like Tamanna said, defense is back in flavor post the minister's comments, in addition to the infra theme. And I think we'll see some substantial moves in some of the infra names today. Read Cement by virtue of a individual deal that has happened too, but it certainly brings regional plays into focus, and we'll talk about that in detail. So defense, cement, that whole bucket stays in focus, in addition to some micro themes. I mean, you'll see sugar, you will see the ethanol blending beneficiaries, maybe still in action, maybe not, and so many assumptions around what will happen to large caps and mid caps. There's a Nuama note today, Tamanna, which speaks about what could make it to the large caps and the mid caps and the small caps as well. So lots of action that we're likely to see.
I saw that, but I also saw as one pointer in it that this does not impact flows in and out. So, so does the impact actually restrict itself to inclusion in those indices and then your ETFs and etc., everything else that flows into those funds?
Yeah, also that if it's a half-yearly thing, if some stocks make it to the large caps, and if large cap funds are getting a lot of flows, then automatically those stocks will get flows. But, from a trading perspective, it's been so difficult to try and play this amphi categorization. Select stocks do sometimes, select stocks don't move sometimes. Difficult one to call, but at least we point out where the action likely might be.
Yeah. And you get a sense of how amphi at least looks at these stocks. And I must say, mutual funds, and by virtue of that, essentially retail investors are the big force in the market right now, like you can see from the constant fund flows. The FIIs aren't moving the needle.
Yeah.
They're on the sidelines.
Entirely.
Yeah.
Entirely.
So that's what we're going to see. All right, let's get to that big, list of stocks to watch. And Niraj, you were talking about one particular cement company is Ambuja Cement, and I think that's the big story this morning as well. We're going to have a little more detail ahead on what exactly that means for the space and, of course, for Ambuja Cement. So what has happened? They've acquired 100% stake in Penna Cement at an enterprise value of 10,422 crore rupees. This is, of course, part of the Adani Group. Standard disclosures there. So they're going to be acquiring this cement company, which is a southern-based company. So it's based in southern India. It's being seen as important as expanding the footprint for Ambuja Cement further into the southern part of the country. The acquisition adds about 14 MTPA capacity, so the total comes to 89 MTPA. Out of which 10 is operational and 4 is under construction. That's for Penna. So 10 is operational and 4 is under construction. The capacity is spread across Andhra, Telangana and Rajasthan and improves the market share of the group pan-India by 2%, increasing an 8% market share in the south. So you have a couple of brokerage views as well. Citi is neutral. Citi is neutral because they're saying that most positives appear priced in. But I reckon you might see a sentimental upside today as well. They also say that the transaction EV per ton at $93 is close to greenfield replacement costs, which is, I think, also important in terms of what is the valuation of the company and what essentially Ambuja has paid for Penna. Consolidation in the sector will improve pricing and profitability in the long term, says MK. And, there was an ICRA note out earlier this week talking about how your top 4 or 5 major cement companies are going to have 55% of the market share. They also see a lot of consolidation coming in organically, inorganically, and this is one example of that. And of course, this, secures a foothold in the southern market. I thought it was an interesting deal, Niraj, and of course we'll get an analyst in to talk about it.
Yeah.
But cement is going to be the hottest space for a while, also because of the renewed push on infra spends.
Yeah, and this is a fantastic deal for Ambuja because they are, Ultratech and Ambuja quite up there in the race for being the largest player. Independent of that.
Head-to-head.
Yeah, head-to-head, so to say. And two, at the valuation at which it has been done. So great for Ambuja, maybe not so great for some of the regional players because if a large deal of this nature is done at nearly greenfield replacement cost, $90 or $95 EV per ton.
93 in this case, yeah.
So, some of those which are trading at a higher valuation, Ramco, for example, might all be under pressure today. It'll be interesting to hear from the analysts whether that could happen or not. But I'll watch out, not just for Ambuja today, but also for Ramco and some of the others.
Absolutely, I agree. This is a larger cement story. And, we were talking about the consolidation play that is happening, that the bigger players are getting, more aggressive. So what happens to your small and mid cement companies? All right, talking about smaller players trying to survive, let's look at what's happening with Vodafone Idea, though in a different sector. So the company has approved raising 2,458 crores, so nearly 2,500 crores. We had told you about this board meet, which was expected on the 13th, so that's come through. So they're doing a couple of things. They are trying to pair debt, which was the primary reason. So this is also pairing debt with some of the vendors who they owe money to. But apart from clearing part of their outstanding debt, they also want to expand their 4G coverage and launch 5G services. That's something that they've been saying in pretty much every communication and fundraise. But Vodafone, you might say, some impact sentimentally on this as well. It's been in the eye after the new telecom minister has come in. Indus Tower and Vodafone, both something that you should have on your radar today. You could see some action. Zaggle Prepaid was the other one, and Zaggle was interesting because look at the kind of moves it has been making. So the news for now, for today, is that it's backed with Skydo Technologies, which will facilitate cross-border payments for Zaggle corporate customers. But ICICI Prudential also bought in a stake in Zaggle on the 12th of June. So they had increased their stake there as well. And if you just pull up the way the 1 week chart has been, here's the 1 month chart, but in the last couple of days, Zaggle has been making quite a few moves. So just, and you can see that spike there. So the last 2 days has been interesting. I'd be keen to see if Zaggle has more steam left in it.
Yeah, could be interesting today to watch out for these for sure. I thought Nalco also was interesting. The mining lease deed that they've executed with the state government of Odisha. Now, the area, notwithstanding, 700 hectares is fine. But it's bauxite mines, which is interesting, one. And two, the annual production capacity is 3.5 million tons. But the reserves are 111 million tons, which means it's nearly a 30-year lease that Nalco has now for bauxite mining in Odisha, an additional lease. Well, it could be interesting. Nalco also, by the way, is a part of that list that Nuvama Alternate has put out as a list of stocks which will make their entry into the mid-cap quadrant. So a couple of triggers there for Nalco. If the stock reacts, you never know. But, I was right there on that list. The other interesting thing was this note from Gavikal Research, which says that while we've all been talking about the resurgence of some of the commodities, commodity stocks and commodities by and large have really gone nowhere relative to what you or I may want to think about what's happening. These cyclicals have pulled back dramatically. So, from the recent highs, US energy stocks are down 8-9%, gold miners are down 8-9%, miners, uranium miners are down 10%, copper miners are down 14%, and all of this has happened while S&P and Nasdaq have moved higher. So global commodities aren't exactly the hottest game in town. Bear that in mind. But Nalco is the second stock because of specific news which could do well. And a quick third one on my list today is Cupid. They have received an initial order from Cipla Health to manufacture a range of male condoms under the Cipla brand. More importantly, one, that it's a Cipla order, but two, more importantly, Cipla Health has committed, apparently, to placing regular sizable orders for male condoms with the company in the coming quarters. Wonder if Cupid reacts positively to this news announcement.
So quite a few. I just have a couple of more to add, Niraj. Puravankara was one. Real estate has been doing well as a pack last couple of days, was one of the top gainers in terms of Nifty indices yesterday, the Nifty Realty. And Puravankara, because the board has approved raising up to 1,000 crore rupees via QIP. It was on the cards, but I think you might see a sentimental move there. Wipro, I'm talking about, and Wipro again, you had all the IT companies doing all right yesterday because of the Fed moves, etc. But Wipro, because they've launched an on-premises Gen AI solution in pact with Hewlett-Packard Enterprises. Now remember, if you're not very excited about IT, that's fine. A lot of analysts are not. But if you are interested in IT, the big thing to watch, of course, will be where they are going with AI. And we had a conversation with their AI policy chief yesterday. We played it out. Wipro's being very, very aggressive on the AI value add front. And so this one would be one to watch out. The stock was up 1% yesterday. LIC is the other one. They've increased their stake in Dr. Reddy's from 4.95 to 5.01. So very, very little increase in stake. But the reason I picked LIC is because look at how life insurance companies responded yesterday, and HDFC Life primarily because of the IREDA regulations to increase surrender value. HDFC Life responded well because they were very clear about what their hit on the margins would be. But remember, the impact in absolute terms would be the largest on an LIC because they have the largest market share. So LIC is one where that entire story still needs to play out.
Yep. And just a few block deals, Tamanna, since we were speaking about them. Senco Gold is interesting. SAF Partners have sold 45 lakh shares, which is 5.8%. Now, this is a clean-out trade. And therefore, maybe, just maybe, Senco Gold has an uptick today. If it does, some of it would have been digested. But now that we know that such a large deal from SAF is out of the way, maybe Senco has a bit of an uptick. Usually, clean-out trades bring about upticks at times. So watch out for Senco Gold. L&T Finance was interesting because everything else notwithstanding, Larsen & Toubro, very interestingly, is bought about 1.25 crore shares in that block that happened yesterday. So watch out for LT Finance. And while we're talking of all this rara moves in sugar, a very noted investor, Anil Kumar Goel, has gone out and sold some minor stakes in Dhampur and Dwarikesh in this uptick. That was very interesting to my mind and to the mind of a lot of people who looked at this deal yesterday. Very surprising as well. But he's as marquee a name as they come when it comes to the sugar sector. So interesting.
So what is your inference? What are you reckoning that this marquee investor thinks that it's
he's usually been ahead of the cycle, Tamanna.
So he's run up
on the buying side as well.
Yeah.
Could this be an indication, at least to one person's mind? Let's wait and watch.
Yeah, remember, it's all about the ethanol play. It's all about the ethanol play. So, I mean, and it's a very politically sensitive sector, first of all. So it always comes with its risk. Anyway, from sugar, let's move to cement. Remember, we told you that the big story this morning is about Ambuja Cement buying Penna Industries, which is a southern-based cement company. Uttam Kumar Srimal, Senior Research Analyst of Cement and Intraday Access Securities, is joining us to break it all down. Hi, Uttam. Very good morning to you, and thank you for speaking with us today on NDTV Profit. Let's begin with your take on the Ambuja deal. How do you look at it?
Yeah, good morning, Tamanna, and thanks for having me on the show. Basically, Ambuja Cement is aspiring to reach a capacity of 140 million ton by FY28. So in that context, this acquisition remains a good one, and it will help them to accelerate their expansion program. So enterprise value that is around 10,442 crore for 22 crore, which comes to around $90 USD. So of 14 million ton, which they will be getting, out of that 10 million ton is operational and 4 million ton is under construction. So we believe this is a positive move for Ambuja Cement. It will help them to consolidate their position in the south also, and also accelerate their expansion program moving ahead.
Uttam, good morning. Niraj here.
Yeah, good morning, Niraj.
So this deal, at the valuation that it has done, does it open up or leave any upsides for Ambuja, which a few people are saying has priced in some of the benefits of this and the good work that it has done on the numbers in the past couple of quarters?
Yeah, basically, see, all the assets are basically located in Telangana and Andhra Pradesh, and we know South market is very competitive in terms of pricing also. So Ambuja will have to ramp up the production at these units once this comes to their kitty. So moving ahead, we believe not at present, but moving ahead with the Ambuja having its most of the things like they have got good brand, and with their logistic and other benefit, I believe that they will be able to ramp up the capacity over a period of time fastly. So that will help them to getting more benefit out of this acquisition moving ahead.
So, Uttam, here's the thing. Most people are excited about what will happen in the states of Andhra Pradesh and Telangana by virtue of the change of guard that has happened and the infra push that, for example, TDP brings right to Andhra. My question to you is, does this therefore, over a 3-year period and not just immediately, give that premium to Ambuja, that it's got this large presence in the state where infrastructure development could take priority, and therefore for Ambuja to be able to sell at a premium might be possible?
Yeah, surely, because see, with this capacity acquisition, Ambuja's market share in South will go by 8%. And as you mentioned that Andhra Pradesh government has also announced Amravati as its capital. So they will be building the Amravati. So there will be a lot of infrastructure development in Amravati. So that will be positive catalyst for cement demand. And Ambuja acquiring the Penna Cement, I believe that it's a good time that they have acquired it. And with the ramp up and their all the most of the they have all the benefits with them with regard to logistics and other things. So I believe that over a period of time, in the next 2 to 3 years, they will be in a better position to gain more market share and in the Andhra Pradesh and Telangana, and they can also expand their capacity over there with this after acquiring the current capacity. So I believe it's a positive move on the part of the Ambuja in the long term and they will be able to capitalize on the growth prospect which Andhra Pradesh is currently showing.
Mr. Shrimal, I'm just trying to understand this Amravati play that you talked about, and that saw a huge run-up in Aramco Cement, etc. I'm wondering, A, is it overblown in terms of how much work actually these cement companies are going to get, and B, if there is really going to be a huge push, which are the companies poised to benefit the most?
See, basically, the companies which are located in this particular region are like Penna Cement is there, Andhra, then Sagar Cement is there, then Orient Cement is there, and Dalmia Cement is there, Ultratech is also there. So these are the companies which will be primarily get along with Ramco Cement. So these are the south-based companies. They will primarily get benefit once the development works starts there.
And in these, how would you rank them in which companies are poised to, get the maximum benefit? I'm trying to understand if your smaller regional companies are in a better position or your large pan-India players.
I think this will be beneficial for both regional as well as large pan-India players, because Ultratech is also there and Ramco is also there. So, it will be more beneficial for large cap companies, because they will be able to utilize their assets more than the regional players, and this will help both large as well as small size players in the region.
Okay, just want to take this question a little broader, and I was mentioning this earlier as well in the show about this ICRA note, which says market share of top 5 cement makers will rise to 55%, in fact, by March 2025. Now, we've already seen one big move in terms of consolidation. Mr. Shrimal, do you expect more in this direction, and what is your view on this consolidation move that we're going to see?
Basically, with this consolidation happening, Adani has previously acquired Sanghi Cement, now Penna Cement, and Ultratech has also acquired some part of India Cement, around 2 million ton of capacity earlier. So I believe moving ahead, this consolidation story will play out, and large companies, basically the 5 large companies in India, they will be the beneficiaries of consolidation in terms of economics of scale, supply chain efficiency, more pricing discipline, and all that. So moving ahead, once this further consolidation will help these large players, and this will be beneficial for all the large players, including Ambuja, Ultratech, Dalmia, or Shri Cement, because they will be the most large. And moving ahead, I also believe their share, overall market share of 5 top players will also increase in next 3 to 4 years by between 60 to 65%.
Uttam, I'm just wondering, I wanted to kind of be the devil's advocate on one of the comments that you made, that it could be positive for the regional players. I thought that the valuations at which this has been done might actually be negative for some of the players like Ramco, because at 93, if a deal is happening, then surely people would question the valuations at which Ramco or some of the others are trading at.
Yeah, see, these assets, Penna Cement assets, are not optimally utilized. Because they have got around 10 million ton of 10 million ton of capacity, and their last year turnover was around 1,200 crores. So it means that their capacity has not been fully utilized. So a deal has been done at a Adani has got this price assets at a reasonable price. So Ramco and all other cement companies are trading at much higher valuation than at what value Ambuja has got Penna Cement. So I believe from that point of view, you can say other companies, other regional players are quite at a higher valuation compared to valuation at which Penna Cement has gone to Ambuja Cement. But it is because also because these capacities were not fully utilized. And once it comes to the Ambuja kitty, I hope they will ramp up the capacity and fully utilize the available capacity.
So therefore, Uttam, are you saying that because Penna has gotten the money that it deserved because of underutilized capacity, and that's why these valuations, you do not foresee a corrective move into a Ramco or some of the Andhra-based players?
No, see, basically, these capacities were not utilized fully.
Why. So hence, you don't foresee a correction in Ramco or some of the others because of the valuation which this deal is done, right?
No, I don't see any basic correction in their valuation. Because see, demand is there, and I believe that moving ahead, demand will pick up since this first quarter has been disrupted because of election and all that, and second quarter is March. So half.
We're losing your audio. We're losing your audio there, Mr. Shimal. You want to just check if you're on mute? We seem to be losing his audio there. Nevertheless, I thought that was interesting. That was interesting that you are going to see this kind of a consolidation. And one wonders if you have the two large players, and this is turning into a head-to-head fight, with a significant pan-India presence, then what does that do to the small ones? I'm told he's back. Mr. Shimal, can you hear me?
Yeah, I can hear you.
Okay. Now, my question was essentially, now that you've explained so well the fundamentals of the entire sector and what this deal means, I was wondering what your take is on how Ambuja will react today, your, call on the stock. Would you see a buy right now at these levels? And if you could give me your top picks in this space.
See, Ambuja currently is trading on a standalone basis at 23x EV to EBITDA, which is quite high compared to the valuation which sector gets. So at this moment, we have a hold rating on the Ambuja. But apart from the Ambuja, other cement stocks such as our top picks in the sector are Ultratech, JK Cement, and JK Lakshmi Cement. So we believe that these three stocks are there. And they may do well moving ahead. Ambuja valuation at this juncture is high compared to Ultratech and City Cement, or you take Dalmia or ACC.
So what would be your top pick in this space? One pan-India player and one regional player?
On pan-India player, on the large cap, Ultratech is our top pick, and in the small mid cap, it's JK Cement.
JK Cement in the small cap. All right. Thank you so much, Uttam Kumar Shimal, Senior Research Analyst of Cement and Intraday Axis Securities. They're breaking down the big story this morning. We'll take a very short break, but on the other side, we come back with Agam and the F&O setup. Stay tuned.
Welcome. This is India Market Open. We're taking stock of the futures and options space, and at the moment what we're seeing is consolidation which continues. Well, yesterday's day of trade, it was a very quiet day, and when it comes to the Nifty, of course, were flattish movements and unwinding coming through as far as the futures are concerned. Well, moving on, even in terms of the bank Nifty, again, we did see a little bit of weakness as far as the index goes, marginal weakness though, and further unwinding in terms of the open interest. Now we move into a new week, and in terms of the way things have panned out yesterday, well, we did see a lot of traction across several different strikes, but it was a quiet trading session yesterday, which means that we still do have a lot of traction when it comes to your overall open interest distribution around where we closed yesterday. So in the new week, we are looking at significant amount of writing around the 23,400 calls as well as puts. And this also signifies that traders at the moment are expecting a little bit more consolidation, are not expecting too much deviation from current market levels, that is around 23,300, 23,400 going into the next few sessions. But that said, there was plenty of activity when it comes to stocks out there. So we had names like Oracle Financial Services and Dixon Technologies advancing, looking at a lot of longs. Ambuja Cement, it did see a good 9% increase in open interest, though its underlying didn't do too much. Today is a day where it will react to its news of the acquisition of Penna Cement. In terms of stocks which saw unwinding, let's pull that up as well. So short covering for LTF, HCL Technologies, HDFC Life, of course, on the back of a lot of traction with respect to insurance coming in, and Balrampur Chini along with the rest of the sugar pack, which also advanced with good volumes too. But the question really is that with these markets, what do you do and how do you, in fact, take things forward? Well, let's get in an expert opinion here. We have Amar Dev Singh of Angel Broking who's joining us on the show. Amar, good morning. Thank you so much for joining in. Firstly, let me start off with your view on IEX. Now, this is one counter which is starting to see a little bit more traction of late. What is your assessment and how are you deploying options here?
Yeah, I would say that if you look at IEX, we are seeing some sort of positive momentum building up in this particular stock because it was in for consolidation. If you look on the weekly charts, there was clear-cut consolidation happening. And if you look at the derivatives data also, that's showing long build-up for across the series, the June, July, and the August series. PCR still continues to be around 0.8 for this 27 June expiry. But overall, I would say there is some sort of bullish momentum building in the stock. So this is one stock one can look at. One can look at buying the futures. So June futures, one can look at buying around 175 with a stop loss of 163 and a target of 197 in the short term.
All right. Well, the other one on your radar, Amar, is DCM Shriram. Can you take us to that one?
Yeah, so DCM Shriram is one stock we are seeing that across the board, a lot of stocks have moved up in terms of the sugar stocks. And if you look here also, what we are seeing is that the stock has gained almost 7% weekly gains, and the structure of the stock has changed over the last few, I would say not last few, almost 8 to 10 weeks. So that's a significant span of time. And also what we witnessed is that the volumes have increased significantly. Average volumes have increased significantly in the last few days. So this is one stock one can keep a close watch on for a target of 1163 and a stop loss of 981.
And the final one on your radar is also from the sugar pack. Amar, Balrampur Chini was also on our radar this morning.
Yeah, so if you look at the sugar stocks have, I would say, taken off after a long span of time. And if I look at Balrampur Chini, this is one stock which has delivered almost 10% returns. And in this week itself, post the from 360 levels currently. So it's taken out a crucial zone of resistance. And if I look at the data for Balrampur Chini, yeah, we are seeing overall that the put call ratio for this series is 0.91. So if someone wants a longer term view, then one can look at the July series and hold on to or look at buying and hold on to it, because the stock has broken out of a major zone of resistance, so which was earlier around 400, 420 levels. So the stock has a potential to rally significantly if it sustains above the current levels. and could rally towards 475, 480 level. So this is one stock one can look at. The stock has got good support coming around below the 430. So the stop loss needs to be below the 430 levels.
Okay, there you have it. Well, Amar, taking a moment there to thank you for joining us and giving us those calls this morning in the futures and options space. We'll continue to keep an eye on that one. Of course, two of them featuring from the sugar sector, which has been a buzz yesterday. But with that, it's over to you all.
Thanks a lot for that, Agam. So, well, that's the option data. And remember, these 10 minutes, you get the best options advice if you are indeed a hardcore options trader, and you should try and log into this piece that Agam does every single day on India Market Open. And pretty interesting ideas, some of them, Tamanna.
Yeah, absolutely. I was just looking at some of the brokerages today as well, Niraj, and this is something that you highlighted, the Kotak note on Adani Ports, which has come in, and the price target has been raised for the stock at 1650. This was already a stock that has been running up a fair bit, and the group stocks in focus, standard disclaimers of course, but what Kotak is saying is that volumes grew 14% in April, May versus low to mid single digit growth in the market. So comparatively, you've seen a huge push over there. They see potential of growing existing capacity by 5 to 6 times and increase volume estimate by 5 to 6% for FY26 and 27. So I thought that was an interesting one.
Yeah, so many people talk about how port capacities or airport capacities, once built, are an annuity business that keep on giving out, and such a high margin business. So no surprise that most brokerages are bullish. Kotak is the latest one. There are a couple of others in the recent past which has come out and raised target prices on Adani Ports as well. So pretty interesting, the kind of bullishness and optimism that is coming on that particular stock.
Yeah. So talking about brokerage notes, quite a few that we're featuring this morning on the show. And the next one is something Mahima's talking about. Nuvama has talked about how it expects the latest AMFI categorization to take effect. It comes into play, remember, from August 1st. So what are the changes expected? Mahima joins in for more.
Right, Tamanna, so as you rightly mentioned, the cutoff period for this categorization will be from Jan 1st of 24 to June 30th, 24, and the categorization is based on the average market cap over the 6 months. Now, the categorization does not lead to any incremental inflow or outflow, and approximately large caps will be valued around 83,000 crores and mid cap around to hover around 27,700 crores. Now, in terms of potential large cap entrants, there are stocks like Hero Motocorp, Zydus Life Sciences, JSW Energy, NHPC, BHEL, Samvardhana Motherson and Bosch. Then stocks like Berger Paints, SBI Cards, Marico, SRF, ICICI Lombard will move from large cap to mid cap is what they're expecting. Potential mid cap entrants could be stocks like IRB Infra, Bharat Dynamics, BSC, Cochin Shipyard, Nalco, Blue Star, and 2 new stocks that have recently come out with their IPO, Bharti Hexacom and GoDigit. And lastly, stocks which can move from mid cap to small cap include Z Entertainment, Piramal Enterprises, Devyani International, Ramco Cement, etc. So this is the kind of shift in categorization that Nuvama is expecting, which will be announced in the first week of July.
Okay. Mahima, thanks for that. And, some stocks make a large cap entry. Some stocks move from large cap to mid caps as well. But the larger list of those stocks which are making an entry into the mid cap are the ones that move from the small cap to the mid cap category. And I'll just explain why this is important. Because if fund flows are coming in the large cap funds, let's say, then if stocks categorized as large caps or which get freshly categorized as large caps, there is a natural inflow of buying into those stocks from the mutual funds for all the fresh flows that come into those funds. And therefore, if you believe that large cap funds are getting a large sum of money, or conversely, if you believe by your analysis that mid cap funds are getting a lot of money flow, then those are the stocks that you got to focus on. Some of those stocks can actually get some fairly strong inflows. It won't happen uniformly, viewers, keep that in mind. But it's an interesting list to analyze, research, and then try and take a hypothesis-based call. So watch out for some of those stocks as well. Okay, let's talk about technicals for a moment. Kush Bohra, founder at kushbohra.com, joins us on the show. Kush, great having you as always. Thanks for joining in. Good morning. How are you feeling about the indices this morning?
Hi, morning, Niraj. Well, a bit like the Mumbai weather. I know we're thinking this is positive, but maybe a little bit gloomy. And I'll tell you why. We've been opening positive for the last 3-4 sessions, but not been able to sustain those high levels, especially on the bank Nifty. The 50,000 mark seems like a very high wall to cross, and we've not been able to do that. So a little cautious. I'll still try and put this optimistically. This market is a buy on dips, and there are two ways to play that. One, when the dip comes, you do get in and buy, and the other way is that when the markets are giving you that momentum but not able to sustain, you wait for that dip. So right now I'm in a space where I will wait for that dip to come around, maybe around 23,000, 22,800, or perhaps a little higher also, but closer to 23,000 is where I'll be comfortable buying the Nifty.
Good morning, Kush. Yes, this is the weather where you break out the chai pakoda, at least in Mumbai. I'm wondering if that's your plan. Now, you've talked about the Nifty. What about the bank Nifty? Oh, okay, there, yeah. At least not pakoda as yet, but at least some coffee. Let's talk about the bank Nifty as well as, specific stocks that you think are interesting, because this is now a stock picker's market, isn't it?
Oh, absolutely. And I think that is one side that will continue, because even though the indices aren't doing a great deal, the broader markets are surprising on the positive side. The traction that you're seeing in some of the names return, is pretty encouraging. So as I said, the bank Nifty, from a purely technical standpoint, we've spoken about the upward sloping channel for the Nifty and the bank Nifty for some time. Nifty is actually trading at the higher and maybe slightly outside the upper channel. Bank Nifty from that perspective has a room to move up until 50,800. However, the fact that we've not been able to cross the 50,000 mark on a closing basis for the last 4 or 5 sessions is a bit of a concern. So for me, Bank Nifty is also buy on dip. A good support zone comes in at 49,500. So anywhere close to that is where I will be more constructive on the Bank Nifty. Now, as far as stocks go, the PSUs have come back in flavor, and one could not have them, on the radar. One interesting stock is BHEL, and the reason I say it's interesting is because the 300 level had proven to be a bit of a resistance, not able to cross it, not able to sustain above that. We finally, crossed that, closed above it. So from a near-term perspective, 311 is my target on BHEL. 299 is where I would place my stop loss. The other stock from the cash segment that's given a very clear breakout is DCM Shriram. For the good part of this year, the 1,000 level was turning out to be a stiff resistance. Yesterday, it crossed that and on the back of very good volumes. We believe that the upside could continue. From a near-term perspective, 1110 is the target, and 1010 is where I would place my stop loss.
What about Ambuja, since it's the stock this morning which is in focus? What is your take on Ambuja and any of the other cement stocks, Kush?
So on the whole, I'm constructive on the cement space. However, on the Ambuja Cement chart, I see a negative divergence where the stocks actually crossed the high of 670. Yesterday at least that was the high, closed below that. But this negative divergence is don't really put me at a comfort zone. So anywhere close to 640, perhaps 645 is where I would consider a re-entry. On the other hand, Ultratech, this one looks relatively stronger. So if I were to pick one of them right now, I would go with Ultratech. Ambuja will be a buy on dip closer to 645.
Actually, on that note, let's get in Vineet Bolinshkar, Head of Research at Ventura Securities as well. He looks at lots of things, but Vineet, it's great to have you on a day when the large cement deal has happened. We've analyzed it in detail already, but would love to have your views, Vineet. What do you think of this? What does it mean for Ambuja? What does it mean for some of the other regional players?
So, the value discovery is happening at about $120 per ton, which is very, very, in line with what is the replacement cost of a cement plant. I think it will expand the market for consolidation more. And we will see increasingly the smaller players which are under 10 million tons getting bought out, and their valuations are also expected to rise because once the market solidifies into two large players, on one hand you have Ultratech, on the other hand you have Gujarat Ambuja. You are going to be flooded and you are going to be undermined in the market. So a great time for stock pickers. You pick stocks which are the smaller ones who are severely undervalued, and you'll get good value discovery happening because Ambuja has bought Sanghi Cement, and now this Pen Cement.
Okay. Well, so that's on cement, of course, and that's the big deal that happened, of course. The other one is Vineet, commodities. Now, today there is a specific news on Nalco. I don't know if you cover Nalco, but they've gotten this bauxite mine, etc., and stuff like that. And we know what's happening with some of the PSU companies. But I was looking at a note which said that if you look at what some of the commodity plays, uranium miners, steel companies, etc., globally have done, they've virtually done nothing relative to what even the S&P or the Nasdaq have done. So while there is so much of optimism around what commodities can do because of a China reopen, the YTD data on the performance is very lackluster. Would you go out? I mean, are you constructive on any of the commodity names?
See, actually, I'm very constructive on virtually the entire pack of commodities, and I'll give you a couple of reasons why. If you take uranium for consideration, a lot of the uranium which the West was mining was coming from Africa because of the geopolitical sweetheart deals that the colonials had. Now, with those going away, there is shortage of uranium. Canada cannot supply as much as it needs. Europe is dependent on Canada. And, if you see, artificial AI chips are guzzling so much power that today the data centers in the US are looking for demand centers which can consume up to 5 gigawatts of power. And, they cannot find a site more than 1 gigawatt in the US which is ready for mining. So power demand is going to go up, right? When you get into the new age technologies, copper, zinc are going to get mined. When you put Russia out of the equation, aluminum is going to become important commodity which gets mined. So, I think probably we are on the cusp of a very, very big play happening. And one more thing that we have to understand is that, today the US is in such a situation where they cannot cut interest rates even if the economy is kind of stuttering. So because if they cut interest rates, the dollar demand goes down and inflation will start climbing very aggressive. Now, in either ways of status quo, or if they cut rates for token for the elections, prior to elections, we are going to see a tearaway rally happening in commodities. And this is the best point in time where you should be buying commodities, and maybe it might take a month or two, but they're definitely going to fly.
So commodities are definitely going to fly. You need to position yourself well. Vineet, very good morning. Tamanna here. Do you feel the same way about real estate, or what would be your take on real estate? Again, one space which has seen a lot of push, but if we are going to look at further infra spends, growing economy, etc., do you see real estate companies positioned well for this upcycle?
Absolutely. You should take the example of Pune, what happened in the early 2000s when they built the ring road around Pune. The entire landscape of Pune changed, and prices in Pune went up almost 4x in a decade. The same thing is going to happen with cities which are near the new infra projects that are being played out. Road, rail, and water, if you may call it. So tier 2, tier 3 are the places to be. Soba, some of the players in North Delhi like Tak, Anantraj, they all look very, very good in terms of investments.
And there's an interesting note from Kotak Securities today on this as well. So Vineet spoke about some of the stocks that he likes. Kotak speaks about how the residential sector has crossed in FY24 a billion square feet sales mark, which is large for India. And the sales have been coupled with healthy price improvement, about 11% YOY, as a result of which the inventory levels are down to just 15 months. And Kotak says that they expect the sales momentum, much like how Vineet said, to continue unabated in FY25. For them, DLF, Signature Global and Brigade are offering attractive entry points.
Let me get Kush in on this as well. DLF, Signature Global and Brigade. Kush, do you see the merit there? Sorry.
No. I was just saying, or even Anantraj.
Or even Anantraj, yes, which Vineet also mentioned. Yeah.
Well, Anantraj has actually done phenomenally well. and there isn't anything suggesting that the best is behind it or anything of that sort, could take a bit of a pause because the momentum seems to be fizzling out for now. But on the whole, the structure is quite interesting. So if I have a position, I would continue to hold. A DLF also close to resistances, but once it takes out this 900 mark, will become more interesting. For me, something like a Godrej Properties is giving a very clear run, making higher highs, higher highs and higher lows. So that is suggesting momentum. So if I were to trade, I would actually pick Godrej Properties for the near term above Anantraj and DLF also.
Well, quite interesting, really, what's happening with some of these real estate names as well. The other stock that could be interesting, and it's kind of been moving around this 90, 91, 92 zone, is GMR Airports Infra. Now, the reason why this is in focus today is because Chris Wood, Creed and Fear portfolio of Jefferies, has introduced a 4% weighting in GMR Airports in the India long-only portfolio at the expense of banks. Now, be that as it may, if GMR Airports shows a reaction on the back of this, I just wanted to understand from Kush Bora if it's worth a trade, because I think yesterday or day before, we had somebody else, one more analyst come and speak volumes about how the trends in GMR Airports Infra look strong. It's a multi-year breakout at 93 odd levels. Kush, it's not at 93 currently, 91, 91.5. Would you dabble into GMR Airports Infra?
Well, you're right. It's not at 93, and that's exactly the kind of level where the stock has resisted for the most part of this year, starting January, in fact. So if it does give you an opportunity, if let's say the gap up opening is just above 93, not too far away, and some distance away from 100, I will consider a long trade on this. On the whole, constructive. From a momentum perspective, I'm looking at like a 93 only, the level that we've been speaking about, to be taken out. So looks good, looks poised for a breakout. Rather than preempting it, it's a good idea to perhaps wait for the stock to give you that breakout above 93 for a target of 100. I would be tempted to go long. The stop loss therein will come in at about 89 and 90 kind of zones.
Vineet, do you track this airports business? I mean, there is GMR Airports Infra and Adani Enterprises within its, one of its subsidiary has this airport holdings business. Do you like the airports business? Do you like GMR?
Absolutely. And, just hearing that Warren Buffett is looking to buy airplanes very aggressively. So if that were to be a lead, you can be sure that if airlines are going to do well, airports are also going to do well. And, GMR Infra has picked up a lot of properties globally also, and they're now moving from loss to profit area. And we believe that, we are just starting out in terms of a bull market in airports.
All right. The other sort of rejigs as far as Jefferies is concerned, one is on HAL. They've maintained a buy on the company, target price at 5725. So they're excited about that. They are also, apart from GMR, which Niraj mentioned, on Ambuja, they've maintained a buy. We've spoken about Ambuja as well, and HCL Tech. I was wondering if you had a view on HAL. Yesterday, we were speaking, to other analysts as well, and HAL, because of the defense minister's comments, is once again back in focus. Vineet, what do you make of HAL?
So, they have an order book of 82,000. And if you look at the kind of order book to sales kind of ratio, you will find it a tad expensive. But, if you consider the incumbent orders they can get over the next 3 years, I think their order book could easily ramp up to, 1.5, 1.6 lakh crores. And, they have got very, very good margins because they're a monopoly business. And order bookings are also picking up globally. So we believe that, although the stock looks expensive, I believe that this rich valuations can sustain, and the stock is headed higher. So you have to take it, with every swing that plays out.
Where are those opportunities, Kush, as per you, on an HAL right now? When the government comes and says that exports are going to be at never before seen levels, we're going to push Make in India, etc. How do you feel about an HAL?
Well, then now is as good a time as any, right? So it will not be a bad idea to start accumulating these. Although I wouldn't go all out and buy these, lap them up. Perhaps a staggered manner of buying is the way to go about it, because even if you see the run that these stocks have made, there have been times when the stocks actually retraced, come back to its 20-day moving average, and then perhaps given you a bump up. So that's how I would play it. Every time the stock, retests its 20-day moving average is when I would, accumulate some more. But on the whole, the trend looks positive. The comments are encouraging. Yesterday also we saw a big up move. So from a near-term perspective, 5,500 perhaps, or rather a medium-term perspective, 5,500 perhaps looks like a good number. But yes, this now for me is a buy on dips.
HAL is a buy on dips. Now that's interesting. We'll take a very short break, but a lot more to discuss on the other side, and we'll be back with the pre-open race as well. Stay tuned.
Back with India Market Open right here on NETV Profit and a few seconds away from the pre-open session. But be that as it may, very the interesting sector that has done well in the last 2-3 days is sugar. Now, you bullish on hard commodities, I know. Trying to think about sugar. Two reasons. One, of course, with all the comments that have come in and some assumptions that have happened, is the rally justifiable? And two, very interestingly, I saw that while all of this happened, yesterday we had Anil Goel come out and sell small stakes into two of those names, Varikesh and Dhampur. And when Anil Goel does something in sugar, you stand up and take notice. I'm just trying to understand how you think about this space.
See, it's been a rally expecting that, UP will raise the FRP given the fluid political situation out there. Commenting on probable action which is not, even supported by any kind of expectation is, a little too early to say anything about these stocks. But having said that, when we are moving our goalpost to 20% ethanol blending, all these stocks start looking better because the returns, the profitability and assured demand is there. So, this rally from that point of view is justified. But if you're expecting that bulk of sugar will do well, I would just want to restrain myself on that.
Well, that's really the question, because the 20% target for 2025 has been on the anvil. It was a reiteration yesterday, or actually day before yesterday, that we saw from Hardeep Puri, and that's a stated purpose of the government. The only question mark on sugar really is that if the crop cycle turns, if you have any kind of a stress, then that's the first thing to get hit. No government will allow sugar to be utilized for ethanol if there isn't enough in the market for the commodity. So that's really the question. All right. First, rates coming in, and we'll of course wait for them to settle, but we're looking okay. Ambuja Cement up about 5%. That's the stock we've been talking about all morning. Imami looking okay, good this morning actually. ICICI Bank is showing a good boost up in opening trade, about 3% up. Let me quickly go across. Since we talked about Ambuja Cement, there's a whole score of brokerages also on it, and Mihika has compiled all of them that have come in. Mihika, what's the word out there?
Yes. Just before that, a little, context for viewers. Ambuja Cement has announced a 100% stake acquisition in Penna Cement Industries, which is a cement player based in Hyderabad. And the enterprise value of the same is at 10,422 crores. And the acquisition is set to complete in 3 to 4 months and will add 14 million tons of capacity to the Adani Group Cement's capacity. Now, we have Citi, which has a neutral stance on Ambuja Cement at a target of 675. The transaction values, the valuations are of $93 per ton, which is close to the cost for a greenfield project according to Citi. And the transaction also suggests that the company can deliver on its growth plan. But however, it maintains a neutral stance because it feels most of the positives have already been priced in. Next, we have MK, which has a buy rating at a target price of 700 rupees, which is a 5.4% upside to yesterday's close. The acquisition allows Ambuja Cement to secure a foothold in the southern market, and the deal is pegged at a favorable ratio of $89 per ton according to this brokerage, and they maintain the preference on the stock because of Ambuja's strong growth and capex plans, the pan-India presence, as well as a robust balance sheet. And lastly, we have Novama, which maintains a buy rating at a 767 rupee target, which implies a 15.5% upside. The brokerage likes the stock based on the same healthy capex plans and also the measures that the company has in place to lift its cost efficiencies. They also said that the potential turnaround in Penna Cement Industries, which is the target company of this acquisition, will enhance value for Ambuja Cements, and the utilization ramp up of Penna Cement will also bring additional volumes into the market, increasing the competition in the industry. And lastly, even after the transaction, Ambuja Cements will remain debt free with a cash of 24,300 crores, and they also believe that Penna Cement has the potential to achieve a similar turnaround like Ambuja did with Sanghi Industries.
All right, so that's a brokerage take. Let's look at some of these other counters that are buzzing today. I just want to pull up Paytm, and Paytm is now turning out to be a bit of an interesting story. There's a Citi note that has tracked internet usage trends over the last few days, and of course they've marked out Zomato, but they've also talked about Paytm and how it's bottoming out. They say the UPI GMV market share loss may have bottomed out in May of this year. Traffic trends still subdued given current hold on new customer acquisition. But Paytm 2.5% up today, a day after it saw a 7-8% jump because of its tie-up with Samsung for Samsung wallet users. Vineet, do you think the worst is over for Paytm, or is it too early to make that call?
It's a little too early. We need to rework the entire thing because they are not allowed to do any kind of fintech lending, and simply doing Paytm UPI, there's no real modes out there.
Just got a slightly patchy line with Vineet Bolinchkar, but that Citi note speaks about how Zomato has seen a great uptick in that May month because of IPL and Blinkit driven uptick as well. So Zomato is in focus. Then Paytm is in focus as well because Paytm apparently hasn't done too badly there. The one segment which apparently has not had the best of months relative to what was expected is Nykaa. And therefore and Cartrade of course has had a good one too. So and Naukri is a good one. So 4 positives One, Nykaa, not quite the strongest of months. So do keep one finger out there on some of those stocks as well. Actually, Kush, coming on a Zomato after having this brief fling with 200 has come off, not quite able to go back there. Is it facing resistance? If you had it in your portfolio, would you stay long? Or if it was a trading bet, you would take profits off?
So if it was a trading bet, then yes, I would take some money off the table. The 20-day, the 50-day moving averages are proving to be a bit of a resistance to take out. But from a medium to a long-term perspective, this is a consolidation after the run that we had seen. If you remember, somewhere in mid-March, the stock was close to 150 levels. From there, it's jumped all the way to 200. So quite a run the stock's already had. Now going quiet for some time is actually very healthy for the stock to consolidate in this range. Even there, the stock respecting its support zone. So from a medium term perspective, there is no issue at all. Continue to hold. But if you were a trader, then of course you'd feel the pinch because the momentum seems to be missing. So from that perspective, you could perhaps take some money off the table.
Okay. Take some money off the table in Zomato if it was a trading play. So bear that in mind, is what Kush Bora is saying. What else? From today's newsmakers, if you will, of course, Ambuja, Nalco, Cupid, Senco Gold. These are some of the stocks that you should keep in mind. And Ambuja, I think, started off well. Cupid about a couple of percentage points. Senco Gold about 1.5%. Ambuja should come up 3.69%. Really strong show. All the notes talking about it being expensive, but the deal being done at such valuations, leading to Ambuja really having a good one out there. Actually, Vineet has given us his view on Ambuja already. Kush, can I ask you about this? Now that it's starting at these levels, at 689, 690, what would you do with an existing derivative position in Ambuja Cement?
Oh, I'd for sure book profits. When we started the show, Tamanna did ask me about this, and my view was that this is a buy on dips, close to 640, 45 perhaps is where I'd be keen. The gap up is somehow just confirming that, the bulk of the gains that are to be had out of this news and the deal will be lost in the gap up. Also, if you just, dial the clock back, this stock is no stranger to, a 10, perhaps even 20% dip, at times. So, it's not like, you've missed the boat and you'll never get the lower levels. So wait it out. If you have an existing derivative position, book it, in the gap up, and then wait for the dip, close to those 640, 45 levels, be it anytime soon or perhaps, a little later in the, a little later in the day. And by day, I mean figuratively. Wait for those 640, 645 levels to come around for, a fresh long position.
Seeing some of the other, movements this morning, and Aurobindo Pharma seeing quite a bit of weakness, L&T Tech as well. I'm also seeing a bit of, I would say, sluggish trade. Your open rates have settled, and your Nifty has settled pre-open in the positive, but no big moves overall. On the Nifty, I would say that the most moves I'm seeing is from a Hindalco, a Power Grid, and a Shriram Finance once again for a second day in a row. Remember yesterday, Shriram Finance in the closing session hit a life high, had its record market cap, etc. Kush, are you constructive on a Shriram Finance?
I am. I have been tracking this, for a while. This move actually is very encouraging. The resistance for the stock was at 2600 for some time. It's taken that out, by some margin. I think this rally, this momentum could continue. Even on the momentum indicators, it's turned, fairly positive yesterday. So won't be surprised to see, 2850, perhaps, 2950 kind of levels also come in, in the coming weeks. The support zone for anyone who wants to enter fresh will now be that 2600 mark. So that's where you can place your stop loss. But on the whole, the moves are very encouraging and taken out the resistance zones with a bang. So the momentum could continue.
Okay. Mahindra and Mahindra, some flashes on your screen. They plan to introduce 6 new SUV cars by 2030, 7 born electric vehicles by 2030 as well. Now remember, I think in some fashion, this is a part of a larger plan by M&M to be present across the bucket price range on the SUV side, both in the EV and the non-EV space. They have categorically said that they will not go into sedans. They will stick to SUVs, but be across the price range over the course of the next 5 years. With 15 cars, M&M becomes a serious player in the passenger vehicle stroke SUV business, and led by the PV moves, but also by the farm equipment pocket and some of the other subsidiaries doing well. The stock has had a dream run, really. 2875, it's been a prolific performer. Vinit Bulinchkar, would you invest afresh into a Mahindra & Mahindra?
I'll be very honest, I missed this big move in this stock because we were focused very heavily on Tata Motors doing well. But, M&M have figured their act out very well, and it is going to be a veritable competitor with all the big names out there in the SUV market. And since, the entire Indian market is moving upstream, to the value-added SUV segment, I think M&M can bolster itself by further market share gains because, Indians have a tendency to flirt with new models being introduced. And, they're building up their portfolio quite nicely, just the way that Maruti has done, straddled across all price points. I think M&M will be a very, very interesting play to watch out. At these levels, it looks a tad expensive, but any dips are a buy.
Okay, the story this morning is turning out to be banks. At least that's the first sort of cut, and that's what's telling you, likely because of the CLSA report. And look at ICICI Bank, I just pointed it out. But CLSA is talking about how it's the turn of the private banks to come back to the fore. And we'll get a more detailed story up for you in a bit from now. But private banks could be back in flavor. They're talking about how balance sheets have been in a better shape than they've ever been in the last several years. And of the private banks they like ICICI Bank specifically. But look at an Axis also today. You might see some up move there on the index. Kush, just wanted to get your take on the private banking pack.
Well, a fairly similar view as you mentioned. The only thing is that from a near-term perspective, there isn't enough momentum. Some of these names, including ICICI, are taking resistance at some of the key averages. So perhaps from a positional standpoint, I wouldn't really go out and trade them just yet. As I said, the Bank Nifty does have that room towards 50,700, 50,800 mark. But the lack of participation from some of these big names is a bit concerning. That is only from a near-term perspective.
Just want to pull up Havells as well. Now, Havells is expanding its AC manufacturing capacities and has an investment of 50-60 crores. Not much, actually, in terms of total numbers, but that stock is up about 1.5%. In terms of a play, Vinit, do you like Havells?
So we like the entire consumer durable space. We believe that, the rural demand, the way it is coming back, and the way the AC market has moved, the volume play that has happened, it's almost 1.5 times. I think, the entire pack of consumer durables is up for grabs. And I think this segment will do extremely well in the coming years. So Havells, Hitachi, Whirlpool, Bajaj Electricals, all these names are going to see some new renewed vigor come into their stock.
Okay. Well, stay on, gentlemen. We'll just take in some opening thoughts from you post the market beginning, market open, but 30 seconds left to kickstart trade this Friday morning before the long weekend. And it'll be interesting to see if banks, which had a bit of a lull yesterday, and the pickup this morning, can continue that pickup moving ahead. So that becomes very, very interesting. I'll keep an eye out for the sugar stocks as well. And let's see if they continue the momentum. Keep an eye out for defense, more importantly. Let's see if they continue their momentum, because that's where the big move happened in trade yesterday. But here come the first trades this Friday morning. And, well, about 28 points for the Nifty. Hardly any moves there. Very, very flat line performance. Banks, again, flatlining, no big moves there. Mid caps and small caps, about 1/3% for the mid cap index. The small cap index, 0.5%. So that is doing okay. Let's get the heat map up and show you what's moving on the index, if anything. Well, hardly anything. The top gainer is M&M, less than 1%. The top loser is Bajaj Auto, less than 1%. Tamanna, why don't you come in immediately? Because, frankly, on the index, there is nothing. But, no, jokes aside, Power Grid, maybe some moves there. Hindalco, some moves. Bharti Airtel, some moves. A lot of green, very little red. HCL Tech, HUL, Bajaj Auto, Yeah, that's about it.
Market has started its weekend early.
Maybe not on the small cap end. Maybe you have some luck.
Not on the small cap end, but that too, you're not seeing any massive moves, I would say.
Yeah, Adani Enterprises a little bit. Ambuja is not a part of the index, otherwise it would have been right top draw there.
Yeah.
So that's one thing. And Tamanna, you were flagging off Shriram Finance yesterday. That stock is now the top gainer on the index.
Shriram Finance is definitely an interesting play and has been seeing some very smart moves. I'm keen to see if the private banks are holding up, not massively right now.
Not in the top 10 list.
Not in the top 10 right now. But, you're seeing another day of an HUL, etc. doing quite badly. Let's look at what's happening in the broader end of the market, and we'll pull up the small cap and the mid cap indices. And tepid, I mean, relatively all right, all in the green, but nothing major happening there. The small cap is about 0.5% up. Specific stocks, we talked about Ambuja Cement, and we've been talking about morning as the big story of the morning. Let's take a look at how Ambuja Cement is faring in the opening trade. It was positive in pre-open and just about 2.5% up. Now, 2.5% on any other day would seem like not a big reaction, but considering the rest of the market today, it's not bad at all. I also want to pull up what's happening to the other sort of regional smaller players. So let's see a Ramco, let's see a Shree Cement. Ramco's down once again. Shree and Andhra Cement is okay. Andhra Cement is on that whole, new capital Vijayawada sort of, or Amravati actually. Amravati sort of revival move is also seeing, an up move continuing. So that's a different longer term theme that we see. I want to see what's happening with Suve and Pharma. Now they've got a controlling stake in Sapala Organic, and that stock is about 3% up, so not bad at all relatively. Sanofi is also an interesting story. They've seen some wild moves, but that's because they had gone ex-date for their demerger of the consumer business. That stock up 4% up today. It had hit 5% circuit in trade yesterday as well. Block deal impact is something that we can look at. Senco, LT Finance, both of them are seeing large trades this morning, and that's why you're seeing an up move there, relatively speaking. Jefferies has a positive take on GMR Airports, and we discussed that briefly. So you're seeing, slight tick of green. Meanwhile, Havells, another stock in news, they're going to spend 50 to 60 crores to expand their AC unit, 1.5% up. That's been enough for the street to see a bit of cheer, but consumer durables overall looking good. And Prestige Estates is one that I would pull up. CLSA has a positive view. They've got a buy rating with a target price of 2320 that they have bumped up from 1875 earlier. It's still an upside of about 23%, and they expect pre-sales growth of 25 to 30%. So buy call from CLSA has seen a good mood in Prestige, at least this morning. But these are some that we're spotting today, Niraj. Nothing massive, I would say, on either side of the spectrum.
Oh, not at all. Not at all. In fact, even this GMR Airports, for all the introduction of the weightage, etc., is very, very tepid. So we don't have too much in terms of movement, at least at the large cap end for sure. Just wondering, just before I get to our guests, that in the wide market, while there are not too many losers, because Dalmia Bharat is the top loser with a 2% fall, so not too much in terms of a fall. There aren't too many winners. Insurance companies, maybe GIC, New India, 5%, 4% apiece, so both of those. Titagarh Rail is at probably new highs, 1504, 4% higher. We have one railway company, by the way, at 9:30, so that could be an interesting conversation. And sugar continues its up move. Sri Renuka, EID Parry, etc. continue to do well. Opening thoughts, Kush? Anything that catches your eye?
Well, a Lumax Auto Tech, from an investment perspective, stellar, but even from a trading perspective, if you see the stock defying, what the market is doing, there is momentum in this stock. So Lumax, Auto is something that I will have on my radar. From a near-term perspective, I'm looking at 540 as the target, and the stop loss comes in, at 518. So from a near-term perspective, also someone wants to. But, Niraj, as we were discussing, this market is perhaps, a little overstretched or feeling, the fatigue of all the volatility that, we saw last week. So might cool off a bit, and that's also reflected in a lot of stock names now. So perhaps it's not a bad idea to, take some money out, enjoy the long weekend, and then come back on Tuesday and see what happens.
Some of these insurance companies seem to be doing okay, and rail companies continue to rise. Actually, Vineet, come in. I mean, Titagarh to a lot of people at 1,000 was then very expensive. The same Titagarh is at 1,500 now. What do you do with these railway stocks?
I find them a little expensive for my taste. So the railway pack is something which, I need to reassess before making a comment on that.
Okay, and that's fair disclosures. I mean, Vineet is being candid. He's been candid about M&M. He's being candid about the fact that instead of commenting just because I've asked him a question, he better reassess that thing and then come back. Okay, Vineet, let me ask you a slightly simpler question. I see an SKF amongst the list of gainers. The likes of ABB, etc., have continued to march higher. They are expensive names. Would you stay invested there, though?
No, I will not buy those stocks right now.
But if you had an investment?
I'll remain invested. Yes, I will remain invested because they are feeders into the end product, which is manufacturing. And manufacturing has a great run ahead of it over the next decade.
Okay, so that's the story on SKF. Your entire consumer durable pack is having an exciting morning in relative terms, I must quickly add. But Amber Enterprises, Blue Star, Havells, we talked about. Dixon Technologies also seeing quite an up move. I wanted to know your take, Vineet, on Dixon. Dixon Tech is, obviously in the longer term, a lot of exciting things happening for it, but has been relatively quiet recently. Do you think that Dixon is a good buy at this point with the whole PLI sort of thing being taken up once again at full speed now that the election is behind us?
I would definitely be buying all these stocks because, as we said, we are going to see a dream run in consumer durables. Domestic market is picking up. Export opportunities are going to get better. And, there is one indirect play that will boost India's exports is if CNG, if a natural gas comes in the ambit of GST, you're going to see a big thrust in terms of cost competitiveness, not only from the cost of manufacturing, but also from the transit costs. And that is going to make our country a great export play in terms of consumer durables. So definitely Dixon fits that bill right now.
What about you, Kush? You like Dixon?
Well, I do, but the stock looks a little stretched now and seems to be fizzling out. And by that I mean in terms of the RSI setup. Yesterday the move was stellar, but the momentum indicators haven't really caught up. So perhaps there could be some profit booking around the corner. On the whole, the setup is fabulous. The stock always respected the 20-day moving average for the last 2-3 months or so. So again, here too, I would be a little more constructive if I get it at slightly lower levels. So if I have an existing position, I will ride it. But for a new position, I will wait for the dip.
You've been saying that for a lot of stocks, that you're waiting for things to come at a lower level. Now, I want to ask you this question. Do you think that those levels are going to be achieved anytime soon? Because that's where you get stuck, isn't it?
Tamanna, it's so interesting that you observed and pointed out. I realized that myself, and that is perhaps what the market is telling us, right? Because if in a lot of names and across the board, in a lot of stock, if that's the kind of reading that one is getting, then perhaps the market is telling us something that, perhaps there is enough and more done in the recent times, and perhaps we'd want to wait out. I did observe myself saying the same thing for a lot of these stocks, but that's what the reading is, right? So I will go by that. I will wait for a dip on a lot of these names, and I have a feeling that we might be obliged, if not now, in probably a week or two's time.
So that's interesting. Endurance Tech showing a 14.5% jump up this morning. I'm not sure if there's any major news flow, but if you look at the BSE 500, the advanced decline ratio is completely even, Stephen. 244 advances to 248 decline. So you completely hear no clear kind of a flow that you can see at this point. In terms of Vineet, the big moves that you would look at for a pre-budget kind of a play, because that's going to be the next big trigger for the market. We're probably going to see something in the second or third week of July itself. Not too long to wait. What would be the large spaces or the large sectors that you would be tracking?
So we'd be tracking fisheries, one. Two, we are looking at, I personally am very bullish on the infrastructure space, across board, EPC companies, road plays, railway feeder companies, all these are going to do really, really well. Defense as well as, your PSU stocks. So refining for that matter. So these are some of the plays where I'm positioning myself.
Okay. So these are some of the plays. What about you, Kush? Are you also looking at defense? And if in defense, then what specifically?
So two stocks. One is BEL. This stock, we believe that has the potential to go to about 325 in the near term, and a support zone is at 290. So very well placed for that, for that up move and from a risk reward ratio perspective as well. And also a Mazgaon dock. This stock also has seen a sharp revival. It's very close to that resistance zone of 3400. Once that is taken out, we believe even a 3550 is on the cards, and on the downside the support comes in at 3300. So here too very well poised. So the two stocks are BEL and Mazgaon dock, and one stock slightly different from these is ITD cementation. The volumes in this one for the last 2 weeks have been stellar, and so has the move. So I think there is something perhaps cooking in this stock, and could see could cross 500 levels in the coming weeks time. So ITD cementation has been on our radar, so I thought I might as well flag it off.
Okay.
Just one stock that has suddenly bounced is Endurance Technologies. Just a sharp move there, 12.5%. In fact, it was up 16%. If you look at the intraday, fairly volatile and choppy. I don't see it in the volumes that there's a large move there. So I don't think it's a volume-led piece. But I missed out news, if any, on this one. But really strong move on Endurance Technologies in the session today. So do keep an eye out for this one. Vineet, any coverage here? Any thoughts before we let you go? Endurance?
No, I don't track that stock. It's too, the moves are very sparse, and we don't really track that stock.
Okay. Kush, anything at your end on Endurance Tech?
Niraj, I smile because the last time around Vineet and I were together on the show, and you asked me about IT stocks. I said I don't like the likes of HCL and Persistent just yet. It's KPIT Tech and Endurance Tech. These are the two names. Truth be told, I wasn't expecting this move today, but yes, glad to see that one of them's worked. Also, Niraj, the volumes are actually quite sharp, sharply high on this one. So at the current juncture, I would take some money off the table, book profit, and as I said, enjoy the long weekend.
Yeah, but while just a clarification that Endurance is firmly into the auto component sector in some sense. But yeah, the names at times evoke that. But I'm glad that you had spotted it back then, Kush. It was interesting to spot trends, what sometimes charts tell you. Pretty interesting.
Yeah, Kush loves it when he can say, I told you so.
Who doesn't, Tamanna?
which is why that laugh. All right, just quick take on Suven before we wrap up with you, Kush and Vineet. But just a quick take on Suven. So they've had an acquisition in a small CDMO player. But the stock up about 5% and decent moves. Do you like it on the chart?
Not really, Tamanna. Honestly, for whatever reason it may be, I've not been a big fan of this stock. It goes into a long consolidation mode before it gives a breakout, and becomes very difficult to perhaps start putting a number or a time period to it as to when it'll break out. So even now, after this sharp run that we had seen for the most part of the last year, it's gone into this consolidation phase. So not a big fan. If I had something in this, I would book profits and switch to perhaps a Cipla, a Sun Pharma, or a Lupin in this sector.
All right, Suven up about 5% on that news. All right, thank you, Kush Bora and Vineet Bulinjkar, for joining us this morning. We're putting the focus on an interesting report from CLSA that says they prefer ICICI Bank and IndusInd from the banking space, and they're now veering back towards private banks. Varsha joins us to explain why. Yes, Varsha.
Well, thanks, Tamanna, for that. So yes, CLSA has come out with a report wherein they are expecting these forgotten heroes to be well placed after a roller coaster decade. So they believe that Indian banks are well placed after the roller coaster decade that we have seen, and they prefer ICICI and IndusInd Bank. Now, balance sheets, according to them, are strongest in over a decade, and deposit growth should follow. Against this backdrop, if you see, PSU banks have outperformed private sector banks in past 1 to 5 years from a low base, and private sector banks, which have been stock market laggards, according to them, should now give better returns given a good business outlook. And in expensive valuation. Now, they also expect a degree of normalization in unsecured loan growth from 20% to mid to high teens, but they estimate overall loan growth of 14 to 15% over the next 2 years, and they expect private sector banks to continue gaining market share. And lastly, the key concern that they have highlighted is the short-term risk is sharp repo rate cut that would reverse the net interest margin improvement that banks have delivered.
All right. Thank you for that, Varsha, there with that CLSA report and the details on why they like private banks. We saw some very initial burst of excitement in the pre-open session, but nothing much right now on either IndusInd or ICICI Bank as we speak. Very short break, but on the other side, we're talking to Texmaco Rail's Indrajit Mukherjee. Stay tuned.
Well, the investor presentation of Ambuja Cement speaks about a few things, including the fact that this will take Adani Cement's operational capacity to 89 MTPA. Remaining 4 MTPA under construction will be operational in 12 months. And it helps Ambuja Cements to increase its presence in South India, while further expansion in Pan India as well, and multiple other things. It will aid the overall ROCs of the company as well. FY26 EBITDA margin improvement of 2,000 basis points. Maybe there's a typo there. Just wait for that number to come up correctly. But yes, they are certainly expecting a lot of synergy benefits because of multiple things, including the logistic capabilities of Ambuja currently versus what it used to be. Yep, no surprise there that the market is like this deal, 2.5% higher on what is arguably a very expensive stock on the cement side, but certainly moving higher on the account of the acquisition that they've done, which on a valuation basis is near greenfield valuations. Now, a standard disclaimer one, that the Adani Group owns Ambuja Cement, and Adani Group also owns NDTV, and you're watching NDTV Profit. And of course, just keep in mind that Ambuja is expensive. Our guests have come out and said that from a technical perspective, maybe there might be merit in profit booking here, but just the valuation in which the deal has been done is very, very strong, and which is why I think the market likes this piece that is happening with Ambuja today.
Absolutely. Now, from cement to railways, let's shift focus to Texmaco. Indrajit Mukherjee, Executive Director and Vice Chairman at Texmaco Rail, is joining us this morning to speak about the business outlook. Now, this is one space that we were interested in focusing on as well, because, once you've had the cabinet cleared and the Council of Ministers cleared, there's a hope now for policy continuity. You've seen real stocks also doing well. We wanted to check in and see what's happening with Texmaco. So very good morning, Mr. Mukherjee, and great to have you on NDTV Profit, and great to have you back. Let's start by talking about an aim that you have set up for your wagons, and I found this interesting. For FY25, you expect 20,000 to 25,000 wagon tenders, and your order book has also already exceeded 14,000 wagons in Q4 FY24. So let's start the conversation by setting that context. What is driving that optimism, and how do you see it panning out?
Well, I think, as you said, that the continuity of the policy is a great news. We all expected that it will continue the same way. And I think the rail in the country, the development of railways is moving in a very specific and structured manner. And we are moving in the same way. So we are walking the talk. And Texmaco is one of the players who's trying to get the best out of the situation. It's for us, it's a matter of delivery of performance number one, because as you know that we went and raised equity from the market, and it's a time to give it back to our investors through ROCE. So coming back to your question, that I think it's moving in the right direction, then we feel very bullish that such growth will continue, because this growth is just not one coming as a piece, but it's a part of a complete national rail plan, which is a very well-structured document, and we are following the same.
In this national rail plan, obviously now the big trigger next would be to wait and see what the government capex spend is. But for Texmaco, how much of that growth is coming on the basis of what the government sees for railway expansion, and how much is coming from private clients also focusing on wagons and on the freight business?
See, as far as the freight cars are concerned, we are in about 75-25 ratio. And this is because as much as you want, but you have very little flexibility, because we have a huge order from railways, and these, as you know, these orders are all performance linked, which really means that if you don't deliver, then you pay a penalty, a liquidated damage, in other words. So it's important that we meet up the demand of railway, and then the capacity that is left is actually for the time being for the private wagons. But we do expect that the market will grow. And keeping that in mind, we have with us various plans that we are looking into producing more number of wagons.
Can you elaborate on these various plans, or any of them, in terms of, are you talking about expansion in capacity?
Yes, I think there are three major pillars which are going to drive it, or which are driving it right now. Number one is that we have increased production from our existing facilities by adding of balancing equipment. And as you see that we were somewhere at about 300 freight cars a month, and that production has ramped up to 850, and we would soon like to touch even 1,000 numbers. That's a magic number we want to do very soon. So which is by efficiency improvement. This number two pillar that is coming into play would be looking into manufacturing, increasing the manufacturing capacity. And as you may be aware that we already have joint venture with one of the prominent companies, wagon manufacturing companies from Europe, and we are building a new facility in Calcutta, which would really give up more number of products. And it's not that we are keeping ourselves, we also are trying to scan whether it's possible for an inorganic growth. But that's, I think, is a little far too long a story.
Mr. Mukherjee, good morning. Niraj here. So,
good morning, Niraj.
This magic number that you reach, will it be accompanied by operational metrics improving by virtue of size as well as efficiencies improving over a period of the next 4 to 8 quarters?
1,000 numbers will be that. Above 1,000, we would require capacity expansion. Up to 1,000 numbers, we have done lots of homework. And as you see that we are almost 80% through there. So we are very confident of achieving that number. And I think there are demands. Sorry for interrupting.
No. Sorry. I'm sorry for interrupting you. But what I wanted to know is, sir, that you will reach the numbers, I'm sure. But I'm just trying to understand, will it be much more profitable at the EBITDA level and the PAT level? Because, I mean, when I look at the console numbers and March 24 as well, you did very well on the operational metrics, almost at double digits in the previous two. Again, came back to 7% odd. Is there a way wherein, is there a target EBITDA margin, for example, you have in mind? And could higher numbers lead to that?
It certainly will, because as you would know that the more numbers we do, more will be from the private sector, which has a better ARV, average price realization. And also there is a very strong group that's working right now to develop new designs to make specialized wagons. And that's a work that's going on. And I think that's a matter of time. By this time, we hit the road. So all this put together, the whole purpose of going up to the magic number of 1K is to have more value-added products in our portfolio.
Got it. So, sir, when does this happen? And please excuse me, maybe I should have done my homework, but have you given an official guidance for what you would do in FY25 or a 3-year guidance or something like that?
No, we have not given it nothing to the market, and I think it's will not be proper to do it now.
Okay, but is there just getting that piece out of the way, do you try and reach this 1,000 wagons magic number by a particular quarter in FY25, or is it difficult to predict that?
No, FY25. 24-25, yes.
Okay.
All right. Just one last piece, Mr. Mukherjee. What do you think is going to be the big highlight for FY25? And we're all looking forward to the budget. We'll get more clarity there on CapEx. What would you be looking out for specifically?
Well, I think I'm looking at, in addition to what we are doing, which is driving the numbers, I am also looking at in the freight car, there would be more possibility of doing value-added freight cars. And also as far as we are concerned, we are constantly now scanning to go beyond freight cars, which could be many other areas where railways are throwing up opportunities. So we will gradually move, but what we call inside our company, we call it a building block strategy. So we are building the capabilities through blocks and then moving to outside the freight car territory. But that's that we want to be profitable there. So we want to be very careful when we move outside the freight car.
Okay. We'll leave it at that. Mr. Mukherjee, thanks so much for taking the time out and all the best with all of those targets that you have in mind. We wish you all the best for that.
Thank you very much, Niraj. Thank you.
All right. That's Texmaco. And fairly confident about some numbers, about targets that they want to lay out without a specific quarterly guidance given, but fairly confident about the times ahead. That stock too, flattish right now, but otherwise has done okay. Jupiter, Titagar, Texmaco, and the Troika have had a good move, I must say. Okay, let's take a break on that note. On the other side of the break, we'll be joined by BT Venkatesh Vijay Raghavan. He's, of course, the Chief Executive Officer of TTK Prestige. Stay tuned.
back. You're watching India Market Open. Markets are slipping into the red, but only minutely, nothing major there as cause for concern. But that momentum fizzling out is something that we are seeing in the markets after a huge run-up. But what is definitely not fizzling out is news on Ambuja Cement. That is in focus this morning. And Mihika is joining us with more. The company has put out its investor presentation as well. First, sort of communication after the deal has been announced. Mihika, what have they added in terms of detail?
Yes, just for context for viewers, Ambuja Cement had announced its 100% stake acquisition of Penna Cement Industries yesterday. This is at for a transaction is at an enterprise value of 10,422 crores, and the acquisition is expected to be completed in the next 3 to 4 months, and it's going to be funded entirely by internal accruals. Now, when they've mentioned about capacity details, the acquisition will add 14 million tons per annum of capacity to the group, with 10 MTPA currently operating and 4 under construction, and this under construction capacity will also be completed within the next 6 to 12 months. The capacity is spread across Andhra Pradesh, Telangana and Rajasthan, and will improve the Adani Cement Group's market share in the southern India region by 8% to 15% total, and will also improve its pan-India presence by 2%. They've also mentioned certain cost efficiencies. Now, 650 million tons of limestone reserves have been gained by the Adani Cement Group at a nil premium, which is at the pre-auction prices. This will give them an opportunity to improve their efficiency as well as their green power mix. It will also help the company's sea transportation logistics with 5 bulk cement terminals which are located in Kolkata, Gopalpur, Karaikal, Kochi and Colombo, which will serve the Peninsular India region, and the company will help achieve the aim of reaching sea logistic movement of 10% of the total logistic movements by 2028. And lastly, when it comes to profitability, they expect to improve the capacity utilization to 85% by the 3rd year, and this will help achieve the company achieve an EBITDA per ton of 1,500 per ton by FY28.
Mihika, you've had a lot of brokerages coming in and house reports as well on the development. Just give us a snapshot of what they're saying. I think I saw a couple of the notes were fairly positive and talked about how this is an expansion of the company's presence in the southern part of the country.
Yes, like I mentioned, it kind of gives them a foothold in the southern region because of the capacities that Penna Cement has in the south region. The market share will increase to 15% for the Adani Cement Group is what the company has stated. When we talk about brokerages, we have Nuvama, which maintains a buy rating at a target price of 767, which offers a 15.5% upside to yesterday's close. Now, they like the counter because of its healthy capex plan and the measures to lift the efficiency. Nuvama also believes that Penna Cement Industries could have the same turnover that Sanghi Industries saw, and the company will still remain debt-free with a net cash position of 24,300 crores. We also have MK and Citi, which both have stated around $89 to $93 EV per ton, which is the valuations of the transaction. And what they're saying is that this value is at par of what the cost would be for the company to set up a greenfield project, which for viewers, for context, is a project that is set up from scratch. So this is a positive. The valuations for the deal is also positive, is what brokerages are saying.
Okay, thank you for that, Mihika, giving us all the details of the big, deal this morning, which is Ambuja Cement buying Penna Industries, and that stock 2%. Nearly 2% up at this point. All right, let's shift focus to TTK Prestige. Venkatesh Vijayaraghavan is joining us. He's Chief Executive Officer at TTK Prestige. Mr. Vijayaraghavan, a very good morning to you and great to speak with you. Let's begin with, what the quarter gone by has been like. And I know it's been a while and we'll start talking about quarter one in a bit. But I just did see that Q4 and year on year has been a bit of a strain, slightly, some degrowth in net profits, margins also down slightly. Do you see the outlook changing, especially on the EBITDA front?
Yeah, so I think the industry has gone through a little bit of a slump over the last couple of quarters in particular. We do see a revival, but that's a couple of quarters away in my mind. And there's been a stress around consumption. This probably is leading to the numbers that you're looking at this point of time. If you were to look at our journey, we've been very clearly focused on building our margins, being able to utilize their assets a little more strongly. We haven't played the dilution of price game too much to drive short-term growth, and probably that's one of the reasons that you see this pressure coming in. But we do believe as the market starts moving up, the bottoming of the market happens, and this market starts moving up, we would see the growth come back aggressively.
Do you have a sort of a view by when you see that consumer sentiment improving? And the reason I ask is, at least on the FMCG front, which also is a good gauge of consumer sentiment or rural consumer sentiment as well, they are seeing green shoots. I'm wondering if you're observing any of that, or it's a bit of a wait.
It's a bit of a wait. In our view, it's a bit of a wait. While we do see certain areas coming back again, but I think at a broad level, we do think it's going to be a wait, as I mentioned. I wouldn't hazard a guess in terms of the timing, but I think we're still yet to come out of the bottom yet.
Mr. Vijayaraghavan, is there, I've seen a few of the competing firms try to do what you've done successfully thus far, which is set up multiple points, creating the pan-India presence, the branding being done in that fashion, just trying to think of, one, the competitive intensity, and two, what are you doing to counter that?
So rightfully so, when you've been successful and you've got a successful model, you should expect that there would be competitive pressure coming in terms of aping the model. We follow it in two phases. We continue to stay invested in our retail business, which is our retail front end. We've got close to around 700 stores across 371 towns, and we continue to keep expanding that presence. That very clearly gives us, one, a direct connect with the consumer. Two, I think it has been helping us to be able to launch a number of our new products very successfully. As we move forward, we're expanding our presence not just in the metros alone. We're deepening our presence in the metros as the metros start expanding, the big towns and the big cities are expanding. We're also going into tier 2, tier 3 towns as well. So our geographical presence by way of our physical stores, branded stores, exclusive, you would see that expanding as we move forward. We do believe that there is space for the market, and therefore we follow the process of sticking on to what is good for us and continue to expand this particular channel. As far as competitive intensity is concerned, I think we are seeing that happen. The industry is seeing a lot of players coming in, entry barriers being low. The challenge for us as leaders is to continue to lead innovation, lead some of the new practices that the company is known for. Over the last few years, we've seen the company has been leading a lot of thought leadership for the industry, a lot of innovation for the industry, and that's something that we would continue to stick to as our core. And as we start ramping up our new product launches and as we start pushing our stores expansion, we do see that we would be getting growth, probably ahead of the market.
All right. I was just seeing your agreement with Gramya Heart Rural Tech, and it's a small sort of a move. It's the total commitment of orders only 15 crores. But I wanted to understand the strategy behind it with this particular company, and also about your Judge brand catering to the lower price segment. Is that now something that you want to double down on? Because premium is somewhere where you do have strength already.
Yeah, rightfully so. I'll take up the Judge question first and probably go to the acquisition. So we do believe that there is scope for multiple brands to exist in this category. The category is actually seeing, the categories we are present in is actually seeing two types of emerging trends. Premiumization at the top end, and there's also participation from the mass market as well. So we do believe that there is scope for two brands to coexist, and our efforts on Judge in the last few quarters have been accelerated further, and you would see that acceleration happen. So on the top end, we have Prestige, and probably at the mass market level, we would play around with Judge. But we are quite clear that the two brands would have their own individual existence and do not cannibalize each other.
All right. Thank you so much, Mr. Vijayaraghavan, for speaking with us this morning. And I thought it was interesting where everyone wants to go premium. You're also looking at, the lower end of the market as well. With that, it's a wrap on the show. Thank you for joining us on India Market Open, but stay tuned. Talking Point up next.
Thanks for tuning into Talking Point. I'm your host, Niraj Shah. The case for a chat today with a very special guest. And the case for a chat is this. Is there a capex push which will continue? Could there be a shift to welfare? Numbers can't state that. Maybe valuations of stocks can give out the relative safety. Is there valuation comfort in utility stocks even now? Is a question that we ask. And whether chemical space, will it bottom out in FY25, looking at all that's happening around the world in China and in India? Talk about these and more with Samit Vartak, founding partner and CIO, Sage One Investment Managers. Samit, great having you. Thanks for taking the time out. I hope all is well.
All well. Pleasure to be here, Niraj. Thank you so much.
The pleasure is entirely ours. Samit, before I get down to the bare basics, just a broad brush analysis, and I borrow this out of a note that you've done recently, wherein I saw that, when one looks at the profit growth versus the multiples growth that happened within sectors, utility, tourism, industrials, finance, PAT growth much faster than PE growth. Returns were lower than PE growth in materials, chemical, pharma, and no sector saw PAT growth outpace the returns as well. What made you do this study? What's the inference that you draw out of this?
Yes, see, across the markets, I think there is no disagreement that the markets are overvalued, right? But I think what we were trying to showcase, to those when we did our webinar just this week, was that some pockets, majority of the returns have been only because of the P multiple re-rating. So things to do with the capex, the PSU. If you look at the PSUs, which are non-banking, non-energy, the returns over the last 1 year have been 135%, but the P multiple re-rating has been 115% out of that. Right. So similarly is the case with some of the capex pockets. You look at some of the railway stocks. Those were trading at 1-time price to book just 2.5 years back, and many of them are trading at 5, 6, 7, 8 times price to book. Same thing is with the the EV by EBITDA multiple, or any valuation metric that you look. Some of the sectors have multiplied in terms of the valuation metrics, and that's something that we wanted to show. And even with that, right? So there are pockets. There are many pockets which are relatively fine. Nothing is cheap, but there are some pockets which are relatively fairly valued. And if you stay away from really euphoric valuations, I think market does offer you opportunities.
Okay, so let me, before I get to where is it that you might be finding opportunities, Samit, let me try and borrow some of the things that you've noted down and contextualize it with what some of the recent notes have been as well from either sell-side brokerages or even some of your peers. So I'm looking at the first column of your note, which speaks about real estate and how returns have been nearly 175%. But the increase in PAT is only 43%, as a result of which the latest PE multiple is 71 times versus the FY23 PE of 37 times. So it's clearly a sector that has done very well on the multiple re-rating front, even if the PAT growth has not been so good. But I was looking at a Kotak note this morning, which speaks about how when one looks at the inventory levels have fallen to 15 months, which has not happened too far out in the past. And coupled with pricing power and the sales growth that we've seen, maybe some of the players could be offering very good entry points, is their view. I would love to know whether at that 71 PE multiple, are you a seller in real estate? Are you selective in real estate? And if so, what is it that you would want to choose, and how is it that you're boiling down upon those choices?
Sure. Yes. So Niraj, this is a very generic analysis that I've done, and some of sectors like real estate, you can't really value it based on P multiple, and it's misleading. So P multiple is easy to analyze. That's the reason we have showcased that. But real estate is very different because as the profits are booked as percentage completion, right? So real estate should be looked at based on kind of inventory they have, as well as based on the potential bookings they would do over the next few years. And if you use that metric, most of the real estate players, you would see that the kind of bookings they have done in the last 2 years, as well as the potential they have over the next 4 to 5 years, their current market cap is equal to probably the EBITDA they would make over the next 5, 6, 7 years, which is a really, really attractive valuation, right? So I am really positive on the real estate sector. One of our top holdings is also in the real estate sectors. But again, there are some players which are expensive out there, because again, for me, the metric is what kind of cash flow would you generate over the next few years. If the market cap is within the next 5 to 6 years of cash flow that they're going to generate, it's fairly well. And there are many players who fall under that.
And okay, so good to get that clarification, Samit. In the past, Samit, you've played this real estate cycle not necessarily only by betting on the real estate companies, but by ancillaries as well. Has that theme played itself out, or are you selectively still constructive? And if so, some indication about what sector or what theme within that subset does it fall in? Is it cement? Is it tiles? Is it pipes? What have you?
Right. No, so that theme, I think we have been playing since 2016. If you hear me, I think I've been speaking about this segment. So, what we have positioned ourselves is not just where these products are going to be catering to a specific segment like real estate. So for example, structural steel, real estate, it will go into any kind of construction, whether it's building airports, building generic bridges or factories. So their usage is across multiple industries, and hence their demand is generally resilient. Similarly is the case with, say, stainless steel or electrical cables. So that theme definitely continues, right? But some of those themes have become much more expensive today than what they were probably trading at, pre-COVID. Even their valuations are multiple. So accordingly, you need to adjust your allocations to it. So in the long run, you will make money in there, but they are not as attractive as what they were. But like stainless steel, it's a new entry for us over the last 2 years, and that's much cheaper. What probably a lot of these themes which were considered to be commoditized, and hence they were valued accordingly, their perception has changed as they showed the resilience of growth as well as margins. Similarly will be the case with some of these players who currently are considered to be commoditized, but as they go through multiple years of sustaining profitability, even their valuations will get re-rated. I think there are players which are available today at EV by EBITDA of single digits. So you position yourself accordingly. So but the theme is the same. It caters to multiple industries, and it does get benefited because of the capex. And building India is the theme. Whether it's real estate, whether it's building any other infrastructure projects. And we are looking at players which are not purely commodity, where they have the profit predictability, as well as they have margins relatively under their control. They can never go into huge losses. And those are the players we are still, betting on.
Got it. Okay. The other aspect, Samit, is capex, and again, the returns don't quite meet the increase in PAT numbers for these companies. So there has been significant multiple re-rating in some of the capex beneficiaries. I just wanted to understand how you think about some of the subsets here. So, for example, I'm just using names as illustrative examples, but I just wanted to understand how you think about it. And ABB coming out and saying that from a 12-13%, our margins are now at 18%. And probably continue to be that way. Now, these are expensive stocks, but they clock in margin growth, which is substantial, and the market re-rates those stocks and it stays higher. Similarly, for a Siemens, maybe for a Honeywell, maybe for an SKF, maybe for some of the other bearing companies. Now, how do you look at this MNC pack of companies which have got this technology moat around themselves, but are nearly priced to perfection if you look at TTM multiples or 1 year forward multiples? How do you think about them?
Yeah, it's very, very tricky, because what happens is that one has to be careful in terms of whenever there is a capex-oriented growth, right? Because capex-oriented growth is not a consumable kind of a growth. Capex products, last for multiple decades sometimes. So you sell a product, and the cycle of that life cycle of that product is very long. Sometimes 20 years or 30 years, right? So there can be a huge growth in capex for a short period of time, but then suddenly that growth can stop. And what happens, during such times is that because of the demand, the companies go through huge capacity buildup, right? And then at a certain point, when the demand falls off, and it can happen because of change in government or mainly because of government focus changing from capex to something else. At that point, then the capacity utilization drops, and when that drops, your margins collapse as well as your P multiple collapse big time. So getting into such players where the margins are at all-time highs and the demand is at all-time high, I think it's pretty risky. Similar is the case with something which goes into like the railway capex, right? Because once you sell certain railways, whether it's wagons or they will last for many years, and you don't know whether such demand will remain each and every year. Even if you get a gap of 2 years where this demand falls and your capacity utilization drops, you'll see a huge impact on the margin profile, the profitability, and that uncertainty. In a bull market, you pay like a consumer kind of a multiple, but then when the bad times come, you pay a commodity kind of a multiple. And that drop, it's not 20-30% drop in stock prices. It's halves or even more than that. So one needs to be careful. I mean, I'm not saying this across the board, but you need to differentiate between something which is more through capex, going through products which have a very short life cycle versus a very long life cycle, because that demand tends to be very volatile, as well as the margins tend to be very much more volatile.
Okay. Point well noted, Samit, out there. The other thing is, I just want to round off this piece before we take that break. And since we're talking of capex, building materials, infrastructure, for a long time now, cement has been maybe not performing the best. And now we're seeing major consolidation. Last night, Ambuja announced the acquisition of Penna, this TDP coming to power in Andhra Pradesh, bringing out this whole thing of the cement players out there getting the benefits and larger players consolidating. Are you invested in cement? Why or why not? And would you like pan-India versus regional? Can you talk a bit about it?
Right. So cement, I have actually never invested, not because of anything against it, but most of the time the valuations have been high. Cement players have been generally good at maintaining profitability, maintaining the pricing, and hence their valuations have always been high. Cement is a very local player because you can't sort of transport cement from one part of country to another. So it's a localized market, and then the competition is also localized. So it's I feel it's much more commodity oriented, rather than something that we generally like. We like something which is a little more niche, where just building on capacity is not possible for every player. In cement, there has been capacity buildup across the country by many players, and there is so much available capacity to be built up that you don't know what kind of competition you will see over the next few years. We like segments where there are one or two very dominant players, not in just in terms of capacity, but also in terms of their margins have to be significantly better than the rest of the market. And those are the ones where such players keep on gaining market share. They sustain the margins profile, and majority of the growth that would come through because of capex, is taken advantage by such dominant players, which is not the case in cement.
Okay. Fair point. Samit, stay on. We need to take a quick break. On the other side of the break, of course, we talk about, maybe even try and at the end of the conversation with what are the relative valuations of mid caps, small caps versus large caps. He has a good thought there, Samit Vartak does, because the mid cap index is above 55,000 for the first time. So while the large caps may be kind of just ambling along, the activity at the broader end of the spectrum, viewers, is anything but a slow move. It is a sprint that we're seeing, and it's continuing. So talk about that on the other side. Stay tuned. Back with talking point on NDTV profit, and a couple of pockets where the returns growth in the recent past have been commensurate with the increase in PAT. You can count utilities, and you can probably look at PSU, finance and energy, wherein the returns and the incremental increase in PAT has been reasonably in and around at the same levels, if you will. Samit, what does that indicate? I mean, are these pockets strong enough to invest right now as well? I know it will be dependent on what each of the companies individually have done. And what, if they are investable, what within these buckets do you like the most?
Right. I mean, see, for us, we are completely bottoms up, stock pickers. We'll go with earnings. See, I mean, if you look at, we have probably 1,000 companies, to invest in. And if you're just building a portfolio of 20 stocks, you'll find pockets in segments where maybe the earnings haven't been contributing much towards the returns. But I mean, it just the analysis is mainly to showcase how sort of disproportionately the returns have been. There have been segments which have just gone up by 30-35%, whereas there are some others which have gone up by 170%. And in those, majority of those players have gone up without having support from the earnings. So picking stocks is more of bottoms up. It can be from any segment, and hence this is more showing the divergence in returns.
But do you like anything there? Let's say PSU Finance, because I know that, for example, power finance companies at a point of time were attractive enough for you. Are they still attractive?
Yes, absolutely. I think because, see, we look for at least 20% earnings growth. So power finance companies are one of the few finance companies which offer that kind of growth. And if you see their, the balance sheet has been improving. Most of them will probably have a net NPA of 0 in the next year or so. And in an improving balance sheet, when you still have ROE of 20% and growth potential of 20% plus, and trading at 1 year forward price to book of 1.5 times, I think it's pretty reasonable. The historical valuation, have in 2012 it used to trade at 3.5 times price to book, and compared to that, today it's reasonably valued for the kind of growth and the balance sheet that it offers.
PSU banks fall in that category, Samit. Some of them have shown decent asset quality and PAT growth too.
Right. Yeah. So, I mean, see, a lot of investors do invest mostly in the private bank side. My view has been that there is a huge macro support for the PSU segment. If you see 2011 to 2020, during that time period, PSUs were completely out of the market, right? So, their balance sheet was in a really bad shape, huge gross NPAs. So the government went through that cleanup, then they recapitalized. So that was an environment where private banks could take a huge market share away from the PSUs. Now you have a case where they are fully capitalized. They have huge competitive, advantages with the kind of deposits that they get, and they're backed, as a big competitor now. So taking away market share from them by private banks is not that easy. They may even do the reverse, right? And hence the growth for private banks have gone down, and you will see, there will be a long time correction that unless the gross NPAs at the PSUs go up, and the cycle completely turns. At that point, it will be very difficult for PSUs to lend. Right? Otherwise, they will be very competitive. Their rates are going to be very competitive, and may not allow a lot of private banks to make the kind of profits they want to make. Right? So I think relatively they are in a much better position right now. I am personally not invested because even at a PSU bank level, it's very difficult to find 20% plus kind of growth, and that generally is a hurdle for us.
Got it. Point well noted. Samit, sorry, maybe you just briefly mentioned it, but I just wanted to check with you. A lot of people talk about how private banks now offer the chance to invest relative to historical valuations. They are trading at good valuations. Now, because you look at compounded profit growth for the next 3-4 years, or in this